It's something we talked about 5 months ago, how all this cash coming in gave her a ton of firepower. If you tried to bet against the hypergrowth stocks, you were betting against Cathie Wood with a bazooka. But earlier this year, the speculative growth stocks went out of style in the Wall Street fashion show as investors rotated into the kind of boom and bust cyclical stocks that make the most money in a rapidly expanding economy. Now, I warn you that Ark's funds suffered from a glaring flaw, a ridiculous lack of diversification.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. In today's video, I'm reacting to some fresh comments from Jim Cramer, who discusses what he believes to be Ark Invest's biggest flaw, which I actually think is their biggest strength. There's also going to be some valuable lessons about herd mentality when it comes to investing in stocks and how to invest like a moron. The idea here, hopefully, is that you guys can learn some lessons and not do exactly that. So with that said, let's get into the video. And by the way, since I know there's a lot of crypto lovers watching and people who like free stuff, it's your lucky day. For a limited time, you can get up to $250 in free crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. It also helps out the channel. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also using the link in the description. Let's get back to it.
For the last 6 weeks, the hypergrowth stocks have finally shown some signs of life after spending months in the doghouse. But before you get too excited, you need to know that we're not going back to the speculative mania of 2020. Why not? All right, look, last year, these turbocharged growth stocks benefited from what I call a powerful virtuous circle. There was so much money pouring into the group that it would send the stocks higher, which in turn lured in even more money. The best example, look at Ark Invest, the family of exchange-traded funds run by Cathie Wood, arguably the best money manager of 2020.
Of 2020? What? Jim. I'm going to have to start calling this guy Jim 2 millisecond Cramer. He's got absolutely no perspective whatsoever. Try over the last 7 years, and I'm not just pulling this stuff out of my ass. Let's have a look at the performance of some of their flagship funds. Ark Innovation ETF, up over 500% since 2014. I don't know, let me know in the comments below if there's any other money managers with better returns over that period of time in a single ETF that they manage. But it wasn't just a one-off. We're now looking at the Ark Next Generation Internet ETF, ticker on this one, ARKW, up over 650% since 2014. Maybe you might argue, yes, but you had an amazing 2020, Stephen. That's what he's getting at. Look, phenomenal performance. Okay, I totally get that. But here's the thing. Even in the relatively flat period preceding the huge breakout year in 2020, up close to 300% in less than 6 years. I don't know about you guys, but I think most investors out there would be relatively happy with those kind of returns.
Who made people fortunes with some terrific called shots, like pushing Tesla and Bitcoin at much lower levels. Much lower. Really fabulous. Thanks to your incredible performance, Wood's funds were obviously flooded with money last year.
This is a great example of herd mentality, but also some notoriety gained from being dead fucking right and having phenomenal returns. Now, I don't want to shit on people too much for hearing about the Ark Invest ETFs over the last 12, 18 months, then deciding, you know what, I like what they're doing, I'm going to invest. But the question to consider, of course, is when is the best time to own an asset? Before it goes to the moon or after it's gone to the moon? And this just gives some insights into the mindset of the typical investor out there. In fact, just for fun, let me know if there's any OG investors in the Ark ETFs. And what I mean by that, let's say anywhere between 2014, 15, 16, or even 2017. Did anyone watching actually own any of the Ark ETFs in those years? Now, don't get me wrong. Many of the investors who've invested in the Ark Invest ETFs over the last 12, 18, 24 months have done so after hearing about Ark Invest because of the performance, but then actually engaged their brain, learned about Ark Invest's investment strategy, their thesis, what they're trying to achieve, and realized, you know what? I like their style. I understand where they're coming from. I think this is a smart strategy. I'm in. But there is a second cohort of sheep who've just piled in because they've heard about the great returns. These are the same kind of people who'll be the first ones out when they see suboptimal performance over a very short period of time because they don't actually believe in the thesis and the investment philosophy, but instead they're just chasing returns. By the way, shout out to Paperhand Portnoy. This is the kind of mindset of that type of, quote, investor. And just in case anyone's wondering, I personally think that over the next 5+ years, the Ark Invest ETFs are going to absolutely trounce the other indexes, trounce practically every other actively managed ETF out there, and trounce the returns of pretty much every investor you can think of. And here's a bet. Pick any Ark Invest ETF over the next 5-year period and it will absolutely destroy the returns of the S&P 500 index, where the supposedly smart, conservative and safe money is going for investors who don't want the biggest returns but want good returns. I think that all the Ark ETFs will shit all over the S&P 500 returns over the next 5 years. Someone let Graham Stephan know.
Something we talked about 5 months ago, how all this cash coming in gave her a ton of firepower. If you tried to bet against the hypergrowth stocks, you were betting against Cathie Wood with a bazooka. But earlier this year, the speculative growth stocks went out of style on the Wall Street fashion show as investors rotated into the kind of boom and bust cyclical stocks that make the most money in a rapidly expanding economy. Now, I warn you that Ark's funds suffered from a glaring flaw, a ridiculous lack of diversification.
Regular viewers of the channel will probably know my thoughts on diversification. I'm in the same camp as Peter Lynch and Warren Buffett on this topic. Diversification is for idiots, and let me be clear, 99.999% of investors are actually idiots, and therefore diversification is a great idea for those investors. Most of Jim Cramer's audience are also idiots, and therefore probably a good suggestion. However, in the context of where I'm coming from and my personal style of investing, as in sit on the sidelines, don't swing at every pitch that's thrown my way, but instead develop deep, narrow understanding of certain industries, certain topics, certain companies, etc. And only when I have a high level of conviction that I'm right and this is an outsized opportunity, then and only then I swing the bat and really swing for the fences. In this context, diversification is just a poor strategy. Now, Cramer is right in one sense. Ark Invest is heavily concentrated. They only care about disruptive innovation. That, of course, is going to bring with it outsized volatility over the short term. But on the tail end of that, the idea is that they're also going to achieve outsized returns. And of course, we've seen over the last 5, 6 or so years of the Ark Invest ETFs, that is exactly what they have achieved. So Cramer is right in the sense that Ark Invest aren't diversified because no, they don't want to own anything in the old world, anything that's going to get disrupted, any of the companies that are going to be put out of business by these new companies, any of the industries that are going to get absolutely eviscerated because of new technologies, artificial intelligence, robotics, etc. Ark Invest certainly don't want to have fingers in those pies. And that, of course, means that they're inherently going to be more volatile. But over the long term, I personally wouldn't want to be the kind of investor who's so diversified I own oil and gas companies, energy companies, internal combustion engine vehicle manufacturers, legacy financial companies, bricks and mortar retail. I could keep going on. That's what diversification gets you.
So as Cathie Wood's favorite holdings lost their momentum, her ETFs, they got hammered. Right now, though, I'm less concerned with the performance of Ark Invest ETFs and more concerned with the fund flows, meaning how much new money is coming into their coffers to manage. 5 months ago, Ark was still benefiting from the virtuous circle I talked about at the beginning of the year. Cathie Wood had all this new money coming in, and she used it to buy even more of her favorite stocks, which pushed them higher still, bolstering the performance of her funds, which then brings in even more money. While Ark Invest ETFs all peaked in February, these positive fund flows continued through April. Initially, there was a buy-the-dip mindset. Given Wood's tremendous track record, and again, I credit her, tremendous, lots of investors kept throwing money at the funds on weakness.
Buying the dip, pretty smart investment strategy. It certainly beats selling the dip or buying the peak.
But you see, that's no longer the case. Buyers can only take so much underperformance. So in May, Ark experienced its first month of negative flows in over a year and a half. So far, those negative flows have continued through June, even as Ark's signature funds have rebounded from their lows. In short, even with the hyper-growth stocks bouncing off the bottom, the bulls here have a lot less firepower because Cathie Wood no longer has a bazooka. So I want you to just look at Ark Invest's largest funds. Right now, they have 8 ETFs, but the top 3 dwarf the rest. You got the Ark Innovation, the flagship fund that surged from $125 at the beginning of the year to just under $160 at its February highs, 160, okay? These are all really good charts of what I look to be head and shoulders patterns. Since then, it's pulled back hard, falling to 119 as of today. At these levels, Ark's Innovation Fund is now down nearly 5% for the year. S&P's up 11%. Nasdaq's gained nearly 9% over the same period. Ark Innovation's largest holdings are Tesla, Teladoc, Roku, Square, Shopify, Zillow, and Zoom Video. These are great companies, but they're also widely viewed as COVID stocks that Wall Street lost interest in once people started getting vaccinated in large numbers.
Now, admittedly, the drama of 2020 pulled a lot of growth forward on these stocks, but the reason for this isn't quite as it seems. A lot of people now have the perception that the world's going to go back to normal, and these stocks, the likes of Zoom, etc., Teladoc, blah, 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 they're not going to see that same kind of growth. But the whole point here is that the disruption of 2020 actually accelerated the adoption of better ways of doing things. That's why we saw these stocks surge and these companies really gain a lot of exposure. It's a hint at the future. It pulled some of the future towards today. There was a huge overreaction, I think, personally in the stock market. A lot of people selling out of these things when everything was reopening, not realizing it was actually a valuable window of insight into what the future is going to look like.
Then there's Ark's Genomic Revolution, their biotech fund. It's down 7% for the year, including a roughly 25% plunge from its February highs. Once again, same pattern. There you got Ark. Then you got Ark Next Generation Internet, which is only down less than 2% for the year, even as it's fallen nearly 25% from its February highs. Do not get me wrong, though. Cathie Wood's still an incredible long-term performer. Since the end of 2019, her 5 largest ETFs are all up more than 100%.
Am I misunderstanding Cramer here, or is he suggesting that from the end of 2019 until mid-2021, 18 months is long-term? I'm going to have to start calling this guy 2 millisecond Cramer.
Trouncing the benchmarks. Deservedly so. She is a wizard. Her smaller funds have done better than the larger ones this year, even as they've come down substantially from their highs. But tonight, we're not really trying to evaluate Cathie Wood's performance. That really doesn't interest me in this piece. We're trying to get our heads around the Ark Invest phenomena in itself. So let's talk fund flows. Whenever there are more buyers than sellers of an ETF, third-party market makers will effectively create new shares. They buy up all the underlying stocks, then turn those stocks into the ETF issuer and receive a corresponding number of new shares. When that happens, it's called an inflow. And like I said before, inflows create virtuous circles. For over a year, Ark Invest funds benefited from some enormous inflows. However, you can also have outflows. If there are more sellers than buyers, then ETF shares can be redeemed. Third-party market makers will turn in their units and get a basket of the underlying stocks in return, which they then sell. And that outflow obviously puts downward pressure on the whole basket of stocks in the ETF. Now, heading into the hypergrowth peak in February, Ark Invest was still seeing massive inflows. More than $8 billion in January, followed by just under $8 billion in February. Would have been closer to $10 billion if not for some massive outflows at the last 4 trading days of the month, as some investors got spooked when the super speculative growth stocks started to collapse. Now, ever since we highlighted the Ark Invest phenomenon in January, we've been watching the fund flows here in tedious detail. Once March rolled around, Cathie Wood's favorite stocks were getting clocked, but her fund still brought in new money, albeit a lot less than February. Ark's total inflows in March came in at $781 million. That's a lot of money. April was a real battleground. Ark had heavy inflows early in the month, followed by severe outflows in the last couple of weeks. In the end, Ark finished April with $120 million in total inflows, so net positive. There was still money coming in, but it was a lot less than January and February. Now, last month, though, it feels like investors they threw in the towel. According to data from Bloomberg, May was Ark Invest's first month of outflows since October of 2019. For the whole month, the entire family of funds saw $1.9 billion in outflows.
Now, time for a valuable lesson on herd mentality, chasing returns, following the crowd, and failing to think for yourselves. We heard about the huge inflows into Ark's ETFs after their phenomenal performance, and like I said, some of the investors heard about Ark Invest due to the performance, then read into their investment philosophy, disruptive innovation, thought, you know what, I like this, I'll invest. But of course, there's the other cohort of investors who just chase the returns. Oh man, this stuff went to the moon. Obviously, it's going to keep going to the moon. Paper hand investors. And then we hear about the massive outflows after poor performance over a very short period of time. Which type of investors do you think were the clowns who were selling out of their Ark ETF positions in general during May after a very short period of poor performance? Was it the investors who actually understood the investment philosophy, or those who were just chasing returns, panic selling, these kind of fools? I guess the question is, what happened to the people that bailed out of the Ark Invest ETFs after a period of, quote, poor performance? The People who paper-handed, didn't really understand the strategy, didn't understand that volatility would come with the territory. Well, let's see what's happened since the low point in May during the peak of these outflows from the Ark Invest ETFs. The Ark Next Generation Internet ETF, Ark W, up 23% since the low in May. Hate to be one of the people that sold in mid-May. Now the Ark Genomics ETF, ticker ARKG. What happened there? Up 21.7% since the low in May. How about the Ark Invest flagship ETF, the Ark Innovation ETF, ticker ARKK? Up 25.93% since the low in May. Now the lesson here, guys, is to not invest like a sheep. The fact that people were bailing out of the Ark funds, they had record outflows right at the point in time when stocks were on their biggest discounts, and Ark were buying things at their greatest discount, knowing full well that over time these things would actually continue to grow. Just goes to show what happens when you invest not with your brain, but with your emotions. This was the time to be buying the Ark ETFs. This is when they should have had their biggest inflows. But of course, the average investor, using the term fairly loosely there, isn't that smart. This is the period here where we saw the record inflows, right? These paper hand investors then start panicking. Oh my God, the Ark funds are down 20+%, almost 30% since I purchased. Oh my God, it's down 35%. I hate my life, time to sell. Next minute, the Ark funds rebound 25%. This is just a perfect visual example of how dumb the average investor is, and why I say diversification is for idiots, and most investors are actually idiots, and therefore diversification probably a good idea. I mean, just look at this chart. The very peak value here is when Ark was experiencing their record inflows, money going into the fund at record highs. Then, at the trough, record outflows. This is literally a visual example of buy high and sell low. A round of applause to the average investor out there. Of course, we have to acknowledge Jim Cramer's comments here suggesting that the record inflows are causing record amounts of buying, and therefore there's this virtuous cycle. Big inflows mean Ark investors bidding up these stocks, therefore the prices are going higher. Outflows, stocks going down, blah, blah, blah. I kind of get where he's coming from here. The implication is that Cathie Wood and Ark Invest are almost single-handedly moving the stock market. I don't buy this. Certainly, there is a grain of truth in that. There's some element of truth here. If there's lots of buying activity, lots of money flowing into the Ark ETFs, this will put some upward pressure on some of their favorite stocks. But I want to be really clear. Ark Invest and Cathie Wood are not single-handedly moving the markets. The majority of what we're seeing here with the Ark Invest inflows and outflows are investors just chasing gains and then panic selling out at the absolute wrong moment. The lesson here is quite simple. Investors who don't have a plan, don't have an investment philosophy, don't have a strategy, don't know what they're doing, are just following the crowd, are likely to make extremely dumb investment decisions, and more often than not, lose money rather than make money. The reverse is also true. Those investors who, generally speaking, tend to see great returns are investors who know what they're doing. They've done some thinking, they have a plan, they have a strategy, they know what I'm buying, why I'm buying this, how long I intend on holding this, why I will sell, and they follow their strategy and their plan rather than their emotions. For example, I'm currently all in on Tesla stock. I'm still buying Tesla stock with every spare cent. I would like to establish a position in the genomics space. In fact, I started to do this recently, but then Tesla stock was on a massive discount, down around 30-35%. And I was forced to go, you know what, I don't have enough cash, I'd like to buy the Tesla dip, I'd like to keep building my genomics position. What do? I ran the numbers and decided to sell out of my genomics stocks, even though I still have a high level of conviction in genomics and want to continue to build my position in the genomics sector in the future. I decided Tesla's too cheap, can't help myself, need to buy more. Tesla's going to the moon. I see it 10xing over the next decade. I can't say no to this opportunity. I weighed up the risk reward in my mind. Tesla stock down 35% from all-time highs versus the genomics space. Maybe the genomics stocks head to the moon, but that could take a year or two. Maybe, I don't know on the timing on that. Tesla Robotaxi is just around the corner. I cannot miss this buying opportunity. So I made the decision because I have a plan, a strategy, and an outlook for where I see Tesla stock going over the next decade or so. I also know when I'm selling Tesla stock. The only reason that I will sell any Tesla stock, period, is if I need to. Otherwise, I'm hanging on to this until I can find a way to deploy this capital for philanthropy in the future. Of course, anything could happen in the future. Maybe there's major changes within Tesla and I suddenly decide, you know what, this company's going to hell after all. I've changed my position. There's new information. Therefore, my thesis has changed. Then maybe my actions would change. Although I find that very unlikely. The point I'm making here is that I've been buying Tesla stock since 2016. I haven't sold a single share because I had a plan. Many investors who purchased Tesla stock in 2016, 17, 18, 19, 20, and even 21 have sold Tesla stock and now regret it. Not everyone. I'm sure there's plenty of investors who did really well selling Tesla stock as well. but I'd suggest that they're in the minority, and the vast majority of people who bought and then sold Tesla stock did so not because they had a plan, but because they were following their emotions, not their strategy. Bit of food for thought. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget, if you'd like up to $250 in free crypto bonuses with BlockFi, use the link in the description. You can also get 2 free stocks with WeBull and a free stock with Stake, also linked in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.